archaeologists found clay tablets that function exactly like modern revolving credit accounts. They have individual names, outstanding balances, interest rates, and spending limits. But here's what's terrifying. The civilization that invented this system 3,000 years ago mysteriously collapsed. Today, we're using the exact same financial model. The question is, will we meet the same fate? Welcome to Money Stories, where we uncover the hidden histories of finance. Today, we're exploring how the Neo-Assyrian Empire invented credit cards 3,000 years ago, on why their civilization collapsed. Deep in the archives of ancient Mesopotamia, buried beneath layers of ash and forgotten for millennia, clay tablets reveal a financial system so sophisticated, so eerily similar to modern credit cards, that it challenges everything we thought we knew about consumer finance. The Neo-Assyrian Empire of the 8th century BCE developed a credit system that would not be matched in complexity or reach until the 20th century. Then, mysteriously, it vanished. The civilization that invented credit cards collapsed, leaving behind only fragmented records and unanswered questions about whether consumer debt itself might be a civil force. The tablets were first discovered in the 19th century by European archaeologists excavating sites in what is now Iraq. Most were catalogued as simple receipts or commercial contracts, mundane records of agricultural transactions or merchant dealings. But in recent decades, scholars specializing in ancient economies began examining these tablets more carefully. What emerged was stunning evidence of a sophisticated personal credit system that operated across the Neo-Assyrian Empire with remarkable similarity to modern revolving credit accounts. The tablets recorded individual names, outstanding balances, interest rates, and spending limits. A merchant or craftsman could borrow money and repay it over time, with interest accruing on the outstanding balance. The borrower could make partial payments, reducing the balance, and then borrow again against available credit. The system operated on trust and reputation. A borrower with a good payment history could access more credit, while those with poor records faced higher interest rates or denial of further lending. This is the fundamental principle of modern credit scoring. Operating in the ancient world 3,000 years ago, the interest rates varied based on risk assessment. A borrower of high social status or with proven repayment history paid lower interests, perhaps 5 to 10% annually. A borrower of uncertain creditworthiness paid higher rates 20, 30, or even 50% annually. The lenders were primarily wealthy merchants and temple officials who had accumulated capital and were willing to lend it at profitable rates. The borrowers were farmers needing capital for seeds and equipment, craftsmen needing tools and materials, and merchants needing inventory for trading expeditions. The tablets reveal spending limits. A borrower would be granted a credit line, say, 100 shekels of silver. The borrower could draw against this line as needed, but couldn't exceed it. The lender tracked the outstanding balance meticulously. The tablets show notations when payments were made, reducing the balance. New borrowing would be recorded, increasing it again. The system required constant record keeping and accounting, exactly like modern credit card companies tracking balances, payments, and available credit. What's particularly striking is that the system was personal and portable. A borrower didn't need to visit a physical location to access credit. The tablet itself functioned as proof of creditworthiness. A merchant traveling between cities could present his tablet to a creditor in a different region, and the creditor would verify the tablet's authenticity and the borrower's reputation through networks of trust. The tablet was essentially a portable credit account, a forerunner of the modern credit card in every meaningful way. The Neo-Assyrian Empire stretched across Mesopotamia and beyond, encompassing millions of people across vast territories. The credit system operated across this entire empire, facilitating commerce and economic activity on an unprecedented scale. Farmers could borrow to plant crops. Craftsmen could borrow to produce goods. Merchants could borrow to finance trading expeditions. The system lubricated economic activity by making capital available to those without accumulated wealth. It created opportunities for entrepreneurship and commerce that had never existed before. But the system also created debt. As credit became easier to access, borrowing increased dramatically. Individuals could borrow more easily than they could repay. The incentive structure encouraged lending. Creditors earned interest income with minimal effort. The incentive structure also encouraged borrowing. Individuals could consume more than they earned by going into debt. Over time, debt accumulated across the empire, becoming embedded in the economic system itself. The evidence in the tablets suggests that by the 7th century BC, debt had become a serious problem, threatening the empire's stability and cohesion. Some tablets record debt forgiveness edicts issued by rulers canceling debts that had become unpayable. These debt cancellations appear to have been temporary, emergency measures to address crises when too many people defaulted simultaneously. The cancellations would provide temporary relief but didn't address the underlying problem. The credit system itself created perpetual incentives for borrowing beyond repayment capacity. Eventually, the credit system appears to have collapsed under its own weight. By the late 7th century BCE, the Neo-Assyrian Empire was fragmenting politically and economically. The capital Nineveh was destroyed in 612 BCE by a coalition of enemies. The palace archives, containing most of the surviving tablets, were destroyed in fires that accompanied the city's fall. Thousands of tablets were incinerated. Others were buried under rubble and lost to history for centuries until rediscovery. history. The destruction was so complete that the existence of the sophisticated credit system was unknown until modern. Scholars rediscovered and reanalyzed the surviving tablets. Initial interpretations dismissed them as simple receipts or contracts. Only when contemporary economic analysis was applied to ancient records did the systematic nature and sophistication become apparent. Scholars then began asking a provocative question that echoes across time. Did the credit system contribute to the empire's collapse? The evidence is circumstantial, but suggestive and alarming. The empire's decline coincided with apparent financial stress visible in the debt tablets. The repeated debt forgiveness edicts suggest that debt crises were recurring problems throughout the late empire. The increasing difficulty the empire faced in maintaining control over far-flung territories might have been exacerbated by economic dysfunction caused by excessive debt accumulation and financial instability, cascading through society. Some scholars speculate that the credit system created a debt spiral that destabilized the empire economically and socially in ways that weakened its ability to resist external threats. When too many people owed too much money, social cohesion broke down fundamentally. Debtors resented creditors bitterly. The wealthy grew wealthier through interest income, while the poor grew poorer through debt service. Economic inequality increased dramatically. Social tension mounted. When military threats emerged, coalition that destroyed Nineveh, the empire lacked the social cohesion and economic resources to respond effectively. This raises a profound question echoing across millennia. Is excessive consumer debt inherently destabilizing to civilizations? The modern world has built an entire economy on consumer credit. Credit cards, personal loans, mortgages, student loans, trillions of dollars of consumer debt, finance, modern consumption, and infrastructure. The system functions smoothly as long as borrowers can service their debts. But what happens if debt becomes so widespread that large segments cannot repay? The parallels to modern credit systems are striking and unsettling. Modern credit cards operate on identical principles as the ancient tablets. A consumer is given a credit line and can borrow up to that limit. Interest accrues on outstanding balances. Payments reduce the balance gradually. The consumer's creditworthiness is tracked through credit scores, a direct parallel to reputation systems determining ancient interest rates. Modern credit companies assess risk and set rates accordingly, exactly as ancient creditors did. The incentive structures are identical across centuries. Credit card companies profit from interest income. They have incentives to extend credit broadly and keep people in perpetual, revolving debt paying interest indefinitely without fully repaying principal. Consumers have incentives to spend beyond their means, knowing they can defer payment through borrowing. The result is that credit card debt has become permanent in modern economies. With trillions outstanding, consumer debt has become increasingly concentrated among lower-income households, creating a transfer of wealth from poor to rich. Those with wealth access credit at lower rates. Those without wealth pay higher rates. Interest paid by poor households becomes income for wealthy creditors. Over time, this increases inequality and social tension significantly, mirroring patterns that destabilized ancient civilizations. Yet modern civilization hasn't collapsed, at least not yet. The reason is that contemporary credit systems have safeguards the ancient system lacked entirely. Central banks manage money supply and interest rates to prevent debt spirals. Governments implement bankruptcy protections, allowing individuals to escape overwhelming debt. Regulators impose lending standards, preventing reckless credit expansion. The ancient system had no such mechanisms. Once debt became unsustainable, no management system existed to prevent catastrophe. The tablets from Nineveh remained fragmentary and incomplete. Many were lost entirely to time and destruction. Those surviving don't provide complete pictures of the credit system's role in the empire's decline. Scholars can only speculate based on available evidence, but the credit system's existence is undeniable, and its sophistication remains remarkable and prophetic for our modern age. 3,000 years later, we've rediscovered essentially the same system, refined through technology, but fundamentally unchanged in its dynamics and dangers. The Neo-Assyrian Empire learned that credit systems can facilitate prosperity but also create existential risks when debt becomes unsustainable. Whether modern civilization, with our supposed safeguards and regulations, will avoid the fate that befell Nineveh remains an open and urgent question. The ancient tablets offer no definitive answer, only a warning from history. The same innovation that creates prosperity can, if left unchecked, destroy entire civilizations. That's the story of how an ancient empire invented credit cards and paid the price. If you found this exploration of financial history fascinating, subscribe to Money Stories for more uncovered truths about the systems that shape our world. Leave a comment below. Do you think our modern credit systems are sustainable, or are we repeating ancient mistakes? Thanks for watching Money Stories, and I'll see you in the next episode.